Okay, guys, Aaron's giving me the go-ahead. My name is Scott Reese. I'm chairman and CEO of Netherlands Sewell Associates. Netherlands Sewell has been a proud sponsor of the Oil and Gas Conference since the 90s. I think talking to Greg, it was when the first time they started taking sponsors. We were one of the first ones to kind of line up for that opportunity. I'm looking forward to seeing the great 3 days we have lined up for us now. Starting with Comstock Resources, our next presenting company. Comstock is a public company listed on the New York Stock Exchange, ticker CRK, $1.3 billion worth of market cap. They're an oil and gas company based out of, I guess, Frisco, Texas, which is North Dallas. And I say oil and gas company, it's probably more of a gas company, which given gas prices where they are right now is good to say gas company. They produce 1.4 BCF a day and continue to drill out there and be in a great basin. So if you're familiar with the Haynesville is where they operate, where they focus, and it's where they've been making a lot of good wells over the last many years. Here to present the story today is Jay Allison, their chairman and CEO, and Roland Burns, their president and chief financial officer. I think Jay's going to start us off.
Again, we've got a great relationship with most of you. We go back with Netherlands. Fred Sewell used to be on our board. You know, it's funny when you go to the capital markets, the people that buy your debt or the banks, they want a stamp of approval from your reservoir engineers. So when Fred Sewell was on the board until about 2 or 3 years ago, they never questioned our reserves. And we've used Netherlands and Sewell today. We've got probably 99% of our production is natural gas. It's in one basin, which is the Haynesville-Bossier Basin. So yeah, it's nice to have people that, you know, that you're accountable to. And we're accountable to them year in, year out, period. So it's nice to be held accountable. 8 o'clock in the morning, I mean, it's been about 18 months before some of us have been out. I didn't know who'd wear their tie, who'd wear their pajamas, didn't know who'd wear just their jacket, and then below that would be pajamas. I didn't know. So still may not know. From up here, you all look really good. And I got the big light shining in our eye. I've got my good contact on, so I know how much time I can talk because the timer's here at the bottom. We like Teslas. We like electricity. So somebody mentioned Teslas. We're all for Teslas. We want to compete against renewables because we think we're going to be a big winner all the time, and we back renewables. But we are natural gas. We are cheap. We're predictable, and we're worth investing in right now. Not in the future, but right now. Economics matter, and if it didn't, we wouldn't have accessed the capital market in 2020 for the tune of $1 billion. If we didn't have free cash flow, we couldn't have accessed the capital market in 2020 for $1 billion, and in 2022 for about $2 billion. As I was waking up this morning, I thought, well, it's kind of nice to be out of the Zoom foxhole. You know, you're zoomed this, zoomed that, zoomed. I bet I've been zoomed 1 million times. I still don't know how to do it, but I've been zoomed. You know, we went through this personal COVID. Went through it on a personal basis. We went through it on a corporate basis. And the process changed us, changed the industry, changed us individually. And we, on the corporate side, everybody came out different. I said it's kind of like being forced to train for the Olympics. It's a forced training. In the Olympics, all of a sudden, you come out. Some of the companies that went in had debt surgery. I mean, the surgeons trimmed their debt off. It became different. It became better. Some of them, it was painful. They changed their diet. Some of them had reserve revisions that were terrible. And all of us, some of them bulked up. You look at the Appalachian group, you look at the Permian, you bulk up. Size matters, and quality matters. Lean size matters, profitability matters, free cash flow matters, a balance sheet matters, how much availability you have matters, whether you give a preferred or variable dividend matters. You know, it forced us to really see who we were. And I think we came out much better company. We had just bought Covey Park. That was in July of 2019, $2.2 billion. And so 8 months later, we kind of hit the COVID stage. We go from 7 rigs to 4 rigs. We don't frack any wells for 2.5 months, and I don't think in my 35-year history that's ever happened. But we have to see if our reserves are any good. We didn't have any negative revisions. In fact, the revisions we have with our top guard were upward revisions. And the reason we could access the capital market in 2020 during COVID is because we did have free cash flow. In April of 2020, we accessed the capital market with about $210 million of equity. No one in the natural gas world had issued equity since 2016. So we did issue equity in the COVID world. And then we issued about $800 million of bonds in 2020. We took some of those bonds out and decreased our cost of capital. It's a really good story. I'm going to go through it quickly. We've got a breakout after this, and then I think we're here till 5:15 today, so come join us. Thank you for joining us this morning. What does Comstock look like? Why should you invest in it? I always say the key is our proximity. We are 99% natural gas. If you don't like natural gas, you definitely hate us. We're dry gas. If you look at the world of fossil fuels, the single most prolific growing fossil fuel in America, probably the world, is natural gas, period. It's the cleanest, it's the fastest growing, it's in demand, and it may not be a bridge, it may be important, it may be a destination. Who knows? We don't know. A little bit too early on that based upon the economics. But as we look at this, we continued, and we're proud. We had our second quarter conference call probably a week or so ago, and we continue to deliver industry-leading margins. Our return on capital employed, Roland's got some charts on that in a moment. They're exemplary, and it's really because of our locations, and 93% of all we own, we operate. So we could go to 1 or 2 rigs, we could go to 10 or 12 rigs. If growth were important, we could grow you out of your socks because we have access to sell our gas too. But we've maintained our operation plan, throws off a lot of free cash flow. We think we'll have at least $200 million is what we advertised, and that was when gas was $2.70, $2.80. Gas is like $3.30 to $4 today, so we should have $200+ million of free cash flow. Our goal is to pay down our RBL, probably to pay off the 7.5 bonds sometime early next year, and lower our cost of capital. Continue to do that. We are a leader in the basin in the Haynesville. If you look at how many locations we have almost 2,000 locations, and they're de-risked. They're Bossier, they're Haynesville, they're a blend. In all of those areas, we can sell the product if we drill and complete the wells. And we're committed to stewardship. You mentioned it earlier. If you look at where we are on GHG, out of 0 to 45, we've got about 3.12 emissions. So maybe there's 3 or 4 other companies in the universe of oil and gas that emits less than we do. So we've done really well, and that's just because of where we are and that we don't flare, and we're natural gas. So we're always going to we have a check in that box. And then again, it's interesting. You look at all the money managers that have put $1 billion or $2 billion or whatever in as companies. Well, we're a little different. We got a different box, and that's called the Jerry Jones box. He put $620 million in this company when it wasn't popular in 2018 because he bet on natural gas. They kind of made fun of him. And then in 2019, he wrote a check for $475 million. I don't know of anybody that can do that has their own money. And remember, he didn't make a nickel of his money by owning stock. He's never owned a share of stock in his life other than Comstock. So he didn't have a bet in Google or Amazon or whatever and take those dollars and use those dollars to write a check to Comstock. This is the old-fashioned way. So we've got him as a backer, and if there's anything that's transformational that we should buy, I believe that he will supplement what we need and we'll be able to buy it. It's his decision, not ours. He does trustless management. He does not have a board representative. It's a totally independent board. We did reduce the board because we didn't need as many board members. And we've got some great people on the board, but it's independent. I think that shows you the trust. And he doesn't make his money by owning bonds or preferred. He makes his money by owning equity. He owns 140+ million shares. If he converts his preferred into common, he'll own about 180+ million shares of stock. So if it's good for the equity owner, I guarantee you it's good for the banks, and I guarantee you it's good for the bondholders. So our denominator and our anchor is that, period. He owns anywhere from 60 to 68% of the company right now. Visual, I always love visuals. On the top right-hand side, you can see the Haynesville footprint, all that blue, that's our acreage. And as was stated earlier, we do have great size. We've got 323,000 net acres. That's not double counting because we have an upper and lower Bossier either. That's really 323,000 net acres. And we have about 2,000 locations. We've drilled on all four corners of our acreage. We'll show you a slide later on. It is de-risked, and then 73% of those locations are extended laterals. Those are the real valuable ones. The short ones are good. They pay back in a hurry, but your greater economics are longer laterals. We do have leading margins. We have material free cash flow. And we don't have any trouble selling our gas when we drill and complete a well. The one thing that Jones has said, if I drill a well, can I sell the gas? In some areas, the answer is no. And if it's no, then he's not going to put his money in. We said you can in the Haynesville. We have a slide on that in a moment. Kind of the bottom right-hand side, 91% we operate, 93% is held by production. Working interest, 82%. We pretty much control all the wells. That goes back to our CapEx and the percent of operated versus non-operated. Accomplishments quickly, because I'm eating up the clock. $1 billion of equity in 2020. We eliminated this Series A preferred by issuing some equity that saved us $21 million a year in dividends. We came back in 2021. We issued $2 billion of senior notes that reduced our cost of capital and reduced our interest expense per year by about $48 million. And all those add up on the interest cost per MCFE produced. We're like at 52 cents, which is terrible land. And we're down to like 36 cents. I think we should be in the high 20s maybe by year end. If there's terrible land out there, we tell you. If there's good land, we tell you that too. Why would we hide something? We don't play Where's Waldo with you. IP rates, whether they matter or not, is 25 million a day. Most of those are extended laterals. You can see that we had reserve replacement 159%. You can see our reserve base grew 3%. A lot of these companies had negative revisions and they didn't grow their reserve base, and they took billions of dollars of impairments. We didn't have that. Our cost per foot, our drilling group is really good. When we combined with Covey, we took the best of the best in our opinion, and we reduced these costs. This is on a drilled and completed number. Used to be about $1,500 per foot. It dropped down to about $1,050. That's a really good number. It's 15% lower than it was a year ago. And then what's our focus? We're going to pay down our debt. We've got to clean up our balance sheet. Our leverage is too high. We think we can get in the high ones by this time next year, maybe 1.8. We want to drop down to the 1.5. It did hit as high as 3.8, which is terrible. And we levered up to buy Covey. We've addressed that, and we started taking care of that. Corporate strategy, all we're going to do is we've got great inventory. We're going to develop it, keep reducing cost. If there's something out there that we should acquire that's accretive, that helps the equity owner, we'll look at that. We'll decrease our cost of capital. You know, we went from 10.25 bonds to 5.875% bonds. That is a huge decrease in the cost of capital. So, and then we've got active hedges. We're probably 70% hedged in 2021, 40+% hedged in 2022 at really attractive prices. This is a key slide, and I'll probably turn that over to you, Roland. Appalachia versus Haynesville. Haynesville is red, Appalachia is in blue. It all starts with location. If you look at the differentials, you look at the hubs, you know, Perryville's a major hub for the Haynesville, and Dominion South is a major hub for Appalachia. Our price is 19 cents less than Henry Hub at Perryville. Dominion South, which Appalachian, is 73 cents less. So you can see we have an advantage, just an advantage of where we are. Then you go gathering and transportation, G&T. Ours is about 25 cents on average. Theirs is $1.13. Big number. Again, where we're located. And then you take our superior full cycle economics. You take our EBITDAX margins divided over 3-year F&D. We have about 2.5 times. Appalachia's about 1.5. Our IRRs are 61%. Appalachia's 40%. Our average payback is probably 1.6 years. Theirs is 2.2, and if you drill a well here, we can sell the gas. That's a big slide. That just shows you our inventory, shows you our cost. It shows you on the top right-hand side, 306 operated wells since 2014. Nobody's drilled and completed more of these wells than we have. And, you know, we've mentioned earlier, Every metric is positive in the world of natural gas. The supply is low, the 5-year average is low, the 1-year average is low. The demand is incredible for our gas in Asia and Europe. I think everybody's constrained. They're going to be capital disciplined. Everybody wants to give a dividend, a variable dividend. Appalachian is constrained. Maybe they can grow from 35 to 37 Bs the next several years. We're not constrained. LNG exports are at an all-time high. Export to Mexico is an all-time high. It's kind of a perfect environment for us right now. Demand is great. Roland?
All right, thanks. We just have a few minutes here, so we'll cover just a couple of slides here. Real quick, this is just how we sell our gas. We sell our gas, of course, we're all in the Haynesville. So about 40% of our gas is tied directly to Henry Hub or Houston Ship Channel, which are the premium markets because of the huge export demand. And about 60% goes to our regional hubs, Perryville, Carthage. They typically trade 20 to 25 cents, off of Henry Hub prices. But what's going to happen in October, Enterprise, a big partner of ours, is opening up their Acadian extension to Gillis, and we're going to be able to redirect about 20% of our whole gas supply away from Perryville and send it down, to the Gulf Coast. And we think we can pick up another 10 cents or so, for what we can move. This is a slide that's always been a favorite of ours, and a big strength of the company has been our low cost structure. We always had one of the lowest cost structures in the industry. Our operating cost in the second quarter of this year was 59 cents, including including transportation, lifting, and corporate overhead. You can see, it's much lower than all of our gas peers, and you can see a lot of it's the transportation. We're close to the market. We don't have above market kind of firm transportation obligations. That was a real strength of ours when prices were low, and it certainly doesn't help you when prices are high. It just gives you much higher margins. Our margin's 78% in the second quarter on an unhedged basis. It's higher than all of our gas peers, but it's very comparable with the leading Permian companies. If you throw in interest costs, that's always been where we don't compare as well. You can see our all-in operating cost structure was $1 in the second quarter, with 41 cents of that being interest, the largest item there. We've, with our recent financing, we've shaved that down. That was actually in the 50-cent level last year, so it is improved. But on a pro forma basis, we're at 36 cents, but we do see getting into the about 27, 29, 28 cents by the end of this year, really due to both debt pay down and production growth. But even with that higher interest burden, we fare very well to our peers, and soon we'll be leading, and I think leading all of them in a total cost structure. We've done this kind of complicated slide just to say, if you want to reference our cost structure back to NYMEX prices, what can you look at your NYMEX screen. We've thrown in on top of the cost structure the 24 cents, which is our average differential in the second quarter to the NYMEX price. And you can see that all in, everything over $1.19 from a NYMEX price, that's all margin for the company. So, very profitable right now in the Haynesville. If you throw in finding cost, just to get full cycle return cost, our average finding cost for 3 years has been 59 cents. So we're even at, $2 gas, $2.50 gas, it's a very profitable business. We'll skip ahead just to this, maybe just here to kind of this last slide on the balance sheet. That we've really been focused on post the Covey Park acquisition and that period of low gas prices. Our leverage elevated up a little bit, to the high threes, obviously not what the market wants now. We've been very focused on fixing that. We're in the high twos already, and we think we'll get to like 1.5 times by the end of next year. We've done a great job on our debt maturities. We've got an average maturity life of 7.6 years. So, we've got a good maturity schedule. We left some prepayable debt, the bank facility. Jay referenced this $244 million and 7.5% bonds. We want to absolutely retire those with our free cash flow. Once we've achieved that, we'll be returning cash to stockholders, hopefully toward the end of next year. So I know we're kind of out of time almost. We got here we this slide kind of highlights, that yeah, really the big improving story at Comstock is using this period of improved gas prices and capital discipline to, you know, to get a best-in-class balance sheet, which we think we'll have by the end of next year. You know, the big transactions we did and during COVID and 2020, and then the first half of this year, you know, we were able to reduce our fixed costs by almost $69 million. Obviously, all that $69 million now is available to go to free cash flow and to help, you know, pay down debt. So all the heavy lifting in the capital markets kind of was done by us. So now, you know, it's a matter of just operating well, staying disciplined, reducing this debt for the next 3 quarters, then we'll have a great balance sheet. So we'll be over at the breakout session. So if anybody, you know, wants to hear a little bit more about Comstock, join us over there. Thank you.
So I guess you guys heard location, 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 and right place, right time. So they'll tell you more about that in the breakout room. They're going to be in the Platte River A breakout room. And our next presenting company is Talos Energy.